Whether it's learning about earnings estimates, exploring the Zacks rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. You know, every investor has a strategy for finding stocks to buy, but strategies for which stocks to sell, and especially when to sell them, seem to be greatly lacking. So once again, we turn to our editor-at-large, Steve Reitmeister, for some advice in this area, and hopefully you can help us and you can give us a little bit of guidance here. Especially now, with all of the market turmoil, market volatility, I would think, and tell me if you agree, that it would be of paramount importance at this point to have effective strategies on when to sell. So plain and simple, why is it so difficult for investors to sell stocks, and how can they improve their selling strategies?
Yeah, quite often we talk about the psychology in the market, the fear and greed, and obviously we're more pointed towards a fear cycle right now, and that fear that grips people, it does it to them in different ways. Some people become almost paralyzed, the deer in the headlights, and they take no action to benefit their portfolios, and that's obviously not very good. Some people come out fighting, and they are scrambling to do things, and sometimes they can do correct things, but sometimes they do make rash choices, whether that be taking all their money out of the market and running away, and here again, not getting back in the market when it comes back up, so just running and hiding, or just here again, making frantic moves that really were not in their best interest. So fear is definitely playing a role here. Another reason why selling is so difficult and knowing when to sell is the ego gets in the way, and the ego is kind of there to protect your self-worth, and when you take a look at stocks that are going down, if you sell them, then it's like a notch against you, or too many people look at it that way, and it's like, oh wow, I picked a losing stock there, so I'll just sell it when it gets back to break even, and those kind of statements, that is the ego at work. But here again, is it better to take 10-20% loss now as opposed to a 40-50% loss down the road? And so we're going to talk about this philosophy I have called the constant state of break even, which really helps break through the fear and the ego so people can make clear-headed decisions on how to reshape the portfolio, and then within the portfolio perhaps what to do with some of the individual stocks. All right.
So tell us about this constant state of break-even philosophy. I'm kind of intrigued already. How can it help investors?
Yeah, it sounds kind of Zen-like there, doesn't it? The constant state of break-even, I kind of coined that phrase, but really it's just a lot of good advice I've heard over the years, and I have to admit that I'm the son of a certified financial planner, and just growing up with him in the house and his ideas on investing, a lot of it came from him. But you just have to put behind you whether you've made money or lost money. You have to pretend that whatever money you have right now, that's all you got. So let's say you had $200,000 and now it's $150,000. If you keep thinking about that $50,000 loss, you're not going to make smart decisions. You have $150,000. What is the best way to employ that $150,000 right now to be successful? And that, here again, that clear-headed, clean sheet of paper kind of approach is what's going to be most beneficial to investors, to make the right plan and then to enact the right plan.
I'm kind of hearing that clean sheet of paper approach ringing in the background from a recent roundtable.
Oh, right.
You
this week,
employed that on. How does it apply to shaping one's portfolio?
Yeah. So let's take a step back and take a look at how a lot of us got to the shape of the portfolio we're in right now. Back, say, in 2002, we're 2 years into that bear market, and a lot of us got a lot more defensive, a lot more wealth preservation mode in our portfolio, so perhaps had less in the stock market and things of that nature. But then the market started to resurrect, and the market went up 28% in 2003 and went up again in 2004 and 5. And we find ourselves, perhaps we constructed a very conservative portfolio back in 2002, but when the times are good, it starts pulling us out from that strategy, and we get more aggressive. And we have success on that aggressive strategy, and we get more aggressive and more aggressive. And whether that be moving to 100% stocks, or here in the nature of the stock, buying riskier and riskier stocks. And it pulls us away from what might have been the right strategy for us. So coming into 2008, perhaps having an aggressive all-stock portfolio for some of us, especially the closer to retirement you are, may not have been the best approach. So the clean sheet of paper approach, the constant break-even approach is saying, okay, let's put behind us what has happened here. We have our losses this year, so be it. I have this much money left in the world. For me, at my stage of life and my willingness to take risk, how should I shape my portfolio? And I'm talking its blend of stocks, cash, gold, real estate, bonds, etc. What's the asset allocation between classes? And then within each group, how aggressive or conservative I want to be. And now that clean sheet of paper approach, you're going to say how to reallocate your money. Well, guess what? It's now not just a exercise that was for fun. It's something that we can truly apply, meaning that all the other stocks and bonds and everything, we can sell them and move it towards this new portfolio allocation. The only thing stopping us is ourselves. Our fear and our ego is stopping us from making those moves, and it's just the will to do it.
All right, let's remain focused then on how this constant state of break-even can actually help people manage their individual stocks.
Right. And so when it comes down to, so we're talking about the portfolio. Okay, so now I want, depending on the person, 30, 50, 70% in the stock market. So within that portfolio, which ones are the ones that need to go? Which ones are the ones to stay? And so, and quite often it's very hard to do that, because right now, everything's falling, and fundamentals don't seem to matter very much right now. And there are those extreme periods. We've seen that in October of 2002. In July of 2002, we saw that in July of 1997. I mean, we've seen these events, these extreme. Breaking apart of the market, and you throw everything out. Every baby is being thrown out with the bathwater at these times, but it doesn't last. Okay, and cool heads do prevail, and people will come back to the fundamentals of which are the good companies to own, which are the companies that have the best outlooks. Obviously, I'm going to say that for each stock, you want to measure it against the Zacks rank and to make your assessment of which ones are fundamentally sound and which ones are not. Okay, so that kind of background in mind of keeping the ones with the best fundamental picture. So now, a very simple question that everyone can ask themselves. You look at each stock individually. You say, okay, if I had more money to invest in the stock market right now, you're going to like a clean sheet of paper approach, would I buy more of this stock or not? Okay, so if the answer is no, I would not buy more of that stock, then what you're really saying to yourself is you don't see the upside potential in this stock, and probably because the fundamentals have eroded on the company. Not just the stock price is eroded, because right now the stock price is down on everything, but the fundamentals, the earnings outlook for these companies have gotten markedly worse. Okay, if you don't think that you would put fresh money in that stock, then that is the one to sell. Now, if you ask yourself this question, the answer is yes, I would buy more of this stock, then that is the one to hold. And maybe you will add a little bit to the position, but I'm saying this is more of a check of which ones to stay in the portfolio and which ones need to go.
All right, but what about this scenario? What about people who buy more stock in a losing position just in order to lower their cost per share?
Yeah, that's one of the more dangerous things in the market. And sometimes we double down, triple down, quadruple down on losing propositions. So again, if you are applying the constant state of break-even correctly, and you are honestly asking yourself the question, would I put more money in this stock because it's fundamentally sound? If you can answer that question honestly, the answer is yes, then yeah, I'm okay with people putting more money into a stock, as long as, here again, you got good diversification rules, not more than 20% in any one stock. But if it's, here again, the ego at work, and the ego is just trying to say, well, if I lower my costs, then it'll be easier for me to get back to break even. If it's your ego at work, then absolutely that is a losing proposition.
So a certain amount of objectivity has to apply here.
Yeah, absolutely. And the best objectivity in my mind is, again, going back to things that have worked over 20 years. So right now we have a crazy time and nothing's working. Okay, let's just be clear, nothing's working. But when the world gets its head screwed on straight again, okay, and we can think clearly, it will absolutely think in the classic way it always has. Which companies have the best earnings outlook? Are the ones that have the highest fair value? Are the ones that the investor money will flow to?
All right, remind us one more time, if you would, just to underscore here, how to apply this constant state of break-even.
Yeah, and here again, it's just a philosophy of putting fear and ego to the side. It doesn't matter how much money you've lost right now. It's looking at your portfolio with a clean sheet of paper. How would I construct my portfolio now if I had to do it all over again? You put it down, how much you want into each asset class, cash, stocks, bonds, etc., and then you do it. Okay, and then within each asset class, in particular, we like to talk about stocks here. If you're going to allocate, 50, 60, 70% to stocks, some are going to stay and some are going to go. So if you ask yourself, would I buy more of this stock? If the answer is no, it's got to go. That means you don't even believe in the real outlook for that stock, and it's got to go, even if that means you're doing it for a loss. Okay, and if it does sound attractive to you, you would put more money in that stock, then those are the ones to keep, because most likely the ones with the best earnings outlooks, and they're the ones that will resurrect the fastest when the market comes back around.
Sounds like some sage advice, and he's not even that old, folks. There you have some guidance on rebuilding your portfolio and clearing out the bad stocks with Steve Reitmeister. I'm Terry Ruffalo.